Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. Recent central bank communications, better economic growth outlook, and hotter than expected inflation data have all put upward pressure on bond yields over the past month. In early March, the US Treasury yield curve completely shifted above 4% for the first time in this rate hiking cycle. The yield on 2-year US Treasuries has moved back above the federal funds target rate. Amongst major segments of the US Treasury yield curve, the 6-month portion has the highest yield of more than 5%. This is in line with the Atlanta Fed President Raphael Bostic's comments that the central bank could pause the ascent of interest rates in the summer. Fundamentally, these elevated short-term bond yields have three primary cross-asset implications. First, higher short-term rates increase the return expectations of investors from other asset classes. As such, the spread between IBE's consensus expected 12-month forward earnings yield of the S&P 500 composite and the yield of 6-month US Treasury bond is now the lowest it has been in almost 22 years. Second, for investors who use leverage, financing costs go up as short-term rates rise. This does put a constraint on the activity of buying risky assets with borrowed money. Third, for investors seeking to get exposure to US assets on a hedged basis, costs can go up alongside the yield differentials between the US Treasury yields and local bond yields. As one can clearly tell, all these three linkages are negative for equity risk. Yet, equity markets have held up better in the latest episode of rising rates. For instance, during February, the yield on 10-year US Treasury bonds rose by 40 basis points. This caused the global bond index to post losses of 3.3% during February, while global equities lost less than 3%. What explains this anomaly? Well, the answer is growth expectations. It is worth remembering that markets moved from the narrative of hard landing to soft landing to no landing scenario in just the past 2 months. In economics parlance, hard landing refers to a recession, soft landing refers to a slowdown in growth, and no landing refers to a re-acceleration in growth. When added to the mix of higher than expected inflation and hawkish policy, this additional variable of growth proved to be at the margin positive for equities and negative for bonds. At this stage, US rates are not only pricing in a higher peak rate but also have begun to build in some risk premium for a 50 basis point rate hike at the March meeting. While we think it is a right strategy for the Fed to go meeting by meeting, taking a humble and nimble approach in determining policy, we think a 25 basis point hike is more likely than a 50 basis point hike in the upcoming meeting. In case the inflation data continues to surprise on the upside and growth continues to stay resilient, the Fed will be incentivized to lean more towards cycle extension rather than re-acceleration, given its data dependence and the extent to which it has tightened policy already. In terms of financial market outlook, we believe that for bonds, much of the repricing higher of hotter than expected inflation, resilient growth, and tighter policy is mostly complete. Accordingly, we believe that the sharp rises in rates we've seen across the US Treasury yield curve are largely done for the near term. A pause or even a slow rise in US Treasury yields should likely put brakes on the recent US dollar rally and provide relief for risk assets. Key event risks are associated with Fed Chair Jerome Powell's semi-annual testimony to Congress on March 8th, US February CPI release on March 14th, and the FOMC meeting on March 21st and 22nd. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. This is Kishore Muktinutalapati signing off.